Dividends are like bonuses for owning stocks. They are a portion of a company's earnings distributed to shareholders. Imagine getting a little cash reward just for holding onto a company's shares. That's dividends in a nutshell. It's like a thank you from the company for your investment.
When a company makes a profit, they have a choice: reinvest it back into the business or share it with their stockholders. This decision is often made by the board of directors. Dividends are a way for companies to directly reward their investors. It's a tangible return on your investment.
Think of it like owning a piece of a pie. Each share you own is a slice of that pie. When the pie makes money, you get a slice of those earnings in the form of dividends. The more shares you own, the bigger your slice. Dividends are typically paid out on a quarterly basis, meaning you get a little cash infusion 4 times a year. Some companies may pay monthly or annually, but quarterly is most common. Not a bad deal, right? It's a great way to earn passive income.
Now, not all companies pay dividends. Some choose to reinvest their profits. Some companies, especially younger, faster-growing ones, prefer to reinvest all their profits back into the business to fuel further growth. This is common in the tech industry. They believe this will ultimately lead to higher stock prices down the line, benefiting investors in the long run. It's a different strategy, but can be equally rewarding.
Dividends are a powerful tool for investors looking to generate income from their investments. They can be a reliable source of income. They provide a steady stream of cash flow that can supplement your income or be reinvested to buy more shares and accelerate your wealth-building journey. Reinvesting dividends can compound your returns over time.
Stay tuned to learn more about the ins and outs of dividends. We'll dive deeper into how they work and how to incorporate them into your investment strategy. Understanding dividends can help you make more informed investment decisions.
So why would a company choose to pay dividends in the first place? There are a few key reasons.
Firstly, it's a sign of confidence. When a company consistently pays dividends, it signals to investors that they are profitable and financially healthy. It shows they have enough cash flow to not only run their business, but also reward their shareholders.
Secondly, dividends attract investors. Many investors, especially those seeking regular income, are drawn to dividend-paying stocks. These stocks can provide a steady stream of cash flow, which can be particularly appealing to retirees or those nearing retirement. By offering dividends, companies can attract a wider pool of investors and potentially boost demand for their stock.
Thirdly, dividends can help stabilize a stock's price. Regular dividend payments can make a stock more attractive to hold, especially during market downturns. This is because even if the stock price fluctuates, investors are still receiving a cash payment, which can cushion the blow of any losses.
Lastly, dividends can be a more tax-efficient way to distribute profits to shareholders compared to share buybacks in certain countries and tax jurisdictions. This can be an important consideration for companies looking to maximize returns for their investors. Now let's talk about why you should care about dividends as an investor. One word: passive income. It's a powerful concept that can significantly impact your financial future. Dividends are a fantastic way to generate passive income from your investments. They provide a steady stream of cash flow which can be reinvested or used to cover your expenses.
Passive income is money you earn without actively working for it. It's the dream of many investors, allowing you to build wealth effortlessly. It's like having your money work for you, generating income while you sleep, travel, or pursue other endeavors. Imagine the freedom and flexibility this can bring to your life.
Imagine this: you own shares of a company that pays a quarterly dividend. This means you get paid just for holding on to your shares. Every 3 months, like clockwork, you receive a check in the mail or a deposit in your brokerage account just for being a shareholder. It's a reliable source of income that you can count on. That's the beauty of dividends. They provide a consistent stream of income without you having to lift a finger. You can enjoy your life while your investments work for you.
But the benefits don't stop there. Dividends offer more than just passive income. Dividends can also help you fight inflation. As the cost of living rises, so too can your dividend income. Inflation is the rate at which prices increase over time, eroding your purchasing power. It's a silent thief that can diminish your savings. Dividends can act as a hedge against inflation because, as companies grow, they tend to increase their dividends over time, helping your income keep pace with rising prices. This means your purchasing power is preserved.
Moreover, dividends can be a source of financial security, especially during market downturns. They provide a buffer against volatility. When the stock market takes a dip, dividend payments can provide a cushion for your portfolio, offsetting some of the losses you might experience. This steady income can be a lifeline during tough times. This can provide peace of mind and help you stay invested for the long term. Knowing you have a reliable income stream can make it easier to weather market fluctuations and stay focused on your financial goals.
All right, so you're ready to start building a portfolio of dividend-paying stocks. This is a great step towards securing a steady income stream and growing your wealth over time. But where do you begin? The world of dividend stocks can be overwhelming with so many options and factors to consider. Don't worry, I've got you covered. With the right strategies and a bit of research, you can make informed decisions that align with your financial goals. Here are some tips for picking winning dividend stocks. Ones that will not only pay you regularly, but also have the potential to grow over time.
First and foremost, look for companies with a strong track record of paying dividends. This history is a good indicator of reliability and commitment to shareholders. You want to see a history of consistent, or even better, increasing dividend payments over time. This shows that the company is not only stable but also growing. This indicates that the company is committed to rewarding its shareholders and has the financial stability to continue doing so in the future. A company that can consistently increase its dividends is likely managing its resources well.
Next, consider the company's dividend payout ratio. This is a crucial metric that can tell you a lot about the company's financial health. This metric tells you what percentage of a company's earnings is paid out as dividends. A balanced payout ratio is key to sustainable dividends. A payout ratio that's too high, above 75%, could be a red flag, suggesting that the company might be struggling to reinvest enough back into its business for future growth. It's important to find a balance.
Furthermore, delve into the company's financials. This means looking beyond just the dividends and understanding the overall financial health of the company. Analyze their revenue growth, profitability, debt levels, and overall financial health. A company with strong financials is more likely to sustain and grow its dividend payments. You want to invest in companies with strong fundamentals that can support continued dividend payments in the years to come. This ensures that your investment remains sound and profitable. And
finally, don't put all your eggs in one basket. Diversification is a key strategy in managing risk. Diversify your portfolio by investing in dividend-paying companies across different sectors and industries. This way, you can mitigate the impact of any single sector's downturn on your overall portfolio. This helps to spread your risk and protect your portfolio from the ups and downs of any single sector. A well-diversified portfolio is more resilient and can provide more stable returns over time.